Deputy Burton. Now, Deputy Tommy Broughan.
Thanks, Ken Corley. I'm delighted to have the brief opportunity to contribute on the Markets and Financial Instrument Bill 2018 before us today, and particularly like to thank the Oireachtas Library and Research Service, as always, in providing us with some very useful and important backup information. As you know, Ken, your former colleague and the former Minister for Finance and EU Commissioner, Charlie McCreevy, he famously called the stock exchange a casino. And he warned of the dangers, I think, now and again when he was in your seat there, Minister, for ordinary consumers and for organisations trying to protect their savings, insurance, pension and other financial products. And recently, of course, we've seen a widespread public revulsion at the phenomenon of family household mortgages being bought and sold and bundled into so-called financial instruments, securitisation that Deputy Burton referred to be traded on stock exchanges in the European Union, the US and Asia. There's a strong public perception that financial markets have never been properly regulated, and that there has never been any real accountability, and that former Minister McCreevy and Commissioner McCreevy was definitely right. They are casinos where the house always wins and the punter is always at a loss. This perception, of course, is heightened by the horrors revealed in the financial crash of 2008, when the leadership of banks like Lehman in the US, Royal Bank of Scotland in the UK, Anglo-Irish and Nationwide here in Ireland destroyed the credit and pensions of whole nations, and in the case of the UK and Ireland had to be propped up as terrible, at a terrible and enduring cost to ordinary citizens. Indeed, of course, as a country, Ken Corley, we've been plagued for maybe 40, 50 years with a whole litany of insurance and financial scandals going right back to the 1970s, and with the allied failure of the central bank and the Department of Finance to protect us as financial consumers throughout that period. Of course, MiFID I, Markets and Financial Instruments Directive 2004/39/EC, preceded the financial crash. Indeed, MiFID I came into effect in Ireland on November 1st, 2007 and was transposed, of course, via statutory instrument. And MiFID I was the EU's attempt to standardise regulation for investment services across EU member states, but it was clearly a case of shutting the stable door after the horse had bolted. Certainly, MiFID I seems to have had minimal effect in alleviating the kind of Wild West banking and financial market conditions which gave us, and indeed other countries, a decade of austerity and poverty. It's also striking that it's only now, a decade later, that amendments are being made by this bill to MiFID II, the revision of MiFID I, to respond to the disastrous global financial crisis from 2008. MiFID II, of course, and its two linked pieces of EU legislation was transferred into Irish law by statutory instrument as the European Union Markets and Financial Instruments Regulations 2017 SI 357/2017 on August 10th last, and took effect on January 3rd, 2018. And in Irish legislation, of course, the Markets and Financial Instruments and Miscellaneous Provisions Act 2007 permitted criminal sanctions to be imposed for breaches of MiFID I rules. So the bill before us today, the Markets and Financial Instruments Bill 2018, of course, provides for a continuation of the same regime of criminal sanctions for serious offences under MiFID rules. MiFID II, of course, was to be transposed by all Member States by January 3rd, 2017, and it seems that fears that the industry couldn't adapt in time to the MiFID II rules has led to a delay in implementation. And the Minister might respond in relation to particularly Germany and the UK. Is it the case, in actual fact, that they have received long derogations of, is it 30 months? From last January. Obviously, the UK will be a separate economic entity anyway in March 2019, but Germany seems to have had a special regime in this regard. The financial market industry, of course, has apparently complained that MiFID II, with its 1.7 million paragraphs, is onerous and, I quote, hugely time-consuming and has big hidden costs. But the complaints of industry regulators like Stephen Major of ESMA, the European Securities and Markets Authority, suggest that there is a dragging of heels in relation to implementing this legislation. Information on so-called dark pools, which Deputy Doherty referred to, are trading in private venues with prices being disclosed only after trades are completed, which is discouraged, of course, greatly by MiFID II, seems to be totally deficient. Effects by the legislation that targets conflicts of interest arising from how investment managers compensate brokers for research services have also been criticised by analysts who fear that investment managers will cut back on research from brokers and banks. But the issue is, of course, the most important issue there is conflict of interest. But these types of concerns have been relayed to the Central Bank, which has also heard that Irish firms which are part of international groups with broader group-wide MiFID II projects also have the additional responsibility of ensuring that their Irish firms implement their own MiFID compliance steps at local level. I'd echo again the comments of Deputy McGrath, in relation to the fact that we don't seem to get the benefit of the single EU market in financial services. We've seen to have a lot of the downside over the last decade, but where are the benefits in terms of the interest rates and so on that we pay? So I welcome the key elements of the bill before us today, and in particular Section 5, which defines those markets and financial instruments and provides that a person guilty of an offence under the MiFID II rules is liable on conviction or indictment to a maximum penalty of €10 million and or imprisonment for 10 years. And Section 6, of course, empowers the Central Bank to charge fees in respect of its function under the MiFID II Regulations 2017, and Section 7 amends Schedule 2 of the Central Bank Act 1942 to ensure the Central Bank's powers will encompass EU legislation. Section 8, of course, which has been referred to by other speakers, amending Section 2 of the Credit Reporting Act 2013, is very important and extends the definition of credit to include trade credit in the Central Credit Register and on areas of loans, deferred payments and so on. Section 9, of course, an expansion of the definition of long-term financial service to include life assurance products in line with the EU regulations of 2015 is also noteworthy, and also the statutory footing basis to enable the Financial Services and Pensions Ombudsman to respond to consumers' complaints is also very timely. And the key elements, Ceann Comhairle, of the MiFID regulations, which are especially welcome, include the extension of the pre- and post-trade transparency rules provided for under MiFID I to include depository receipts, exchange-traded funds, certificates and other similar financial instruments. And the new high-frequency trading rules are also critical in our era of almost instantaneous and real-time IT systems. And the Minister was referring there, of course, to algorithms and so on, modern computer systems in relation to this, the incredibly fast real-time trading. The corporate and product governance rules in MiFID II are also vital aspects of any type of fair financial market. It is important that banking capital requirements provisions are now being extended to investment firms, that firms must have explicit arrangements for the governance of financial products, and the staff incentives do not cause conflicts of interest. The new trade repository rules also with early consolidated tapes of trade reports and the, I quote, best execution model from MiFID I, requiring firms to take all reasonable steps to obtain best execution of their clients' orders, will also hopefully make financial markets much less opaque. Minister, a huge question mark, of course, over MiFID II and the legislation before us today is posed by Brexit. I mean, concerns have been expressed in the European Parliament and elsewhere that Brexit risks, of course, reversing the impacts such as they are of MiFID I and MiFID II, and this idea that Brexiteers have in particular, that the UK will become some sort of huge offshore financial centre doing its own thing. But given the closeness, obviously, of our market and their market, and we know that ourselves when recently here, Ceann, when we discussed insurance companies, the profound closeness of the UK financial markets and our own. Kay Swinburne MEP, for example, helped to draft, on the parliamentary side, to draft MiFID II. She told a recent conference that, and I quote, all the work we've done over the last decade, fixing the financial crisis, making the global system work, making regulatory cooperation day-to-day activity is in danger of being lost, end quote. And of course, a key part of the Brexit negotiation concerns the kind of access and its cost which London City firms will have to the EU after Brexit. We were discussing this recently, I think, at the Budget Committee, and of course about what Britain's contributions would be post-Brexit, and clearly there will have to be very significant contributions if they want to passport their financial companies into the European Union. The EU has indicated, of course, it will seek enhanced so-called equivalence, but it's difficult to say how this will be agreed and how Irish financial markets will be affected in any post-Brexit free-for-all. So it's a heavy responsibility for yourself and Minister O'Donoghue. There's a real worry also now that the next financial crisis, of course, may come from the non-banking financial sector, where EU and US regulators regulators. They've struggled to keep up with rapidly changing markets. And of course, our stock exchange is now trading as Eurotext and is 100% owned by Euronext, the leading pan-European exchange in the Eurozone. These worries about Brexit impacts on MiFID II and this legislation are very real, and again, perhaps the Minister might address that in his reply. There are other concerns also about the operation of MiFID II. Since January, the European Securities and Markets Authorities, ESMA, reported yesterday, I think, that less than 1% of bonds in the EU today are currently subject to the live reporting requirements in MiFID II, which I referred to above. ESMA said yesterday that in the first quarter, just 220 of the 71,000 bonds it monitors, or 0.3%, were liquid or being traded enough to be subjected to the MiFID II rules. So this report echoes other comments by ESMA over the lack of data for other key MiFID initiatives, including the curbing of share trading on the anonymous venues known as dark pools. Some analysts believe, however, that the number of bonds deemed liquid enough to be subjected to MiFID II's reporting requirements are likely to rise as the quality of data improves. Perhaps again the Minister might comment on these aspects of the likely efficacy of MiFID II, given the generally poor performance or non-performance or non-startup of MiFID I. Some analysts are fearful also that research is now starting to be restricted in small and mid-cap markets due to MiFID II, and so small investors will have much less data on which to base their investment strategies. And I'd echo the comments there of Deputy Burton in relation to, obviously, financial education for young people, and particularly for in the kind of modern perception that people increasingly will be in charge of their own pension arrangements. Lastly, of course, as I said, UK and German regulations have also seemed to have given up to 30 months extension from January 1st for the implementation of MiFID II, and the Minister might also maybe make some comment on that and how it's operated here since January. And the final point, of course, we have had many failures, obviously, of financial regulation over the decades, Minister, and obviously we're hoping that now that this bill and, at long last, attempt to bring accountability into this area will be, an important step in creating a future situation where we don't have to undergo this suffering again. And just want to say one last brief point, make a general point, not to stray too far off the subject. As you know, we were to debate this bill last night, but last night we spent 3.5–4 hours debating a bill which we expected to deal with in the House in 3 or 4 hours the previous week. In other words, 7 or 8 hours have been spent on the road traffic amendment bill. And I deeply respect, of course, the right of all colleagues, to have their say on all matters that affect their constituency, and obviously people have spoken at length, because this bill, the road traffic amendment bill, is a recommittal, and it's a very unusual. Well, I'm just because it's the first opportunity I've had to talk to you publicly, and it is, as you know,
discussed, Deputy, this morning at the Business Committee,
okay,
and a general approach was considered.
Okay. Well, I would hope that would be the case, because I think the character of the debate was unfortunate and was very upsetting, I think, to relatives of victims who were in the gallery. And as you know, there's something like 25–30,000 families have been profoundly affected by road crashes in the past 10 years alone. So I'm glad to hear that the Business Committee you will take an initiative as the leader of the House, the primary official of the House, to ensure that we can have a speedy debate. As I said, we could have had this bill and have had more time for other activities and other parts of the government's agenda today, so I'd welcome that. But in general, I want to say, going back to the bill in front of us, I do welcome it and be supporting it, and although I'm not a member of the Finance Committee, I hope to come back to 1 or 2 issues at report stage. Thanks, Minister.
Thank you, Deputy Broughan.